Hello everyone, it's the 9th of May 2022. I just wanted to do a quick video for you, just having a look at the stock market and just going back a little bit of history to see where we've been and where we're potentially going to. So just to start off with, what I want to do is have a look at the S&P 500. That's the largest 500 companies in the US, and a bit of history, recent history, as to where the S&P 500 has been. It's an index of the largest 500 companies in the US, and this is a 10-year chart, start going all the way back to 2014 to where we are now. So let's just go back to where I want to start off with. Is just before the pandemic started in February 2020. At that time, the S&P 500 was at 3,404 points. Then we had news of the pandemic breaking out in China and starting to spread around the world, which caused widespread panic, lots of governments shutting down to businesses and the entire economy to prevent the spread of the virus. That caused a major panic in the stock market, and we saw a huge crash in February and March 2020. So from that point, just before the crash at 3,404, all the way down to a low of 2,174, that is a 36% drop in the space of a month or two. So very dramatic, very sharp crash in that period. I'm sure you probably remember that with a bit of pain. So what happened thereafter? Thereafter, we saw that the United States Federal Reserve, their central bank, knew that this would cause major pain to businesses and the economy in general, and to try to stimulate the economy, they started dropping interest rates and doing what they called quantitative easing, really trying to stimulate the economy by injecting enormous amounts of money into the system, lowering interest rates. The way they did that was they started buying bonds. So just to give an idea, the quantitative easing was originally running at a maximum pace of $120 billion per month. And so that's an enormous amount of money. And what did that do? That caused the stock, a lot of that money found its way into the stock market, and we started seeing a rally from April 2020, and quite a sharp, dramatic rally, all the way from that low of 2,174, all the way up to 4,808, which was reached in January this year, towards the end of last year. So if we, to give that in percentage terms, if we take it from this level here, just before the pandemic, 3,404, to that top, just over 4,800, that is a 41% rise from that level there to the most recent high, a dramatic increase. And we've seen valuations of many companies around the world getting overvalued, very, very expensive. So what has happened since then? Since towards the end of last year, we started seeing inflation starting to come to the fore around the world, which has caused central banks around the world, including the Fed, which really drives the stock markets to a large extent, getting concerned about inflation and starting to talk about raising interest rates, or so going from quantitative easing to quantitative tightening. So they started talking about it in November last year. They started tapering, as they call it, in November last year, and they actually raised interest rates last week by 50 basis points. And they've also announced that they're going to be doing passive quantitative tightening from the 1st of June 2022. at a pace of $47.5 billion a month. So not only have they stopped the $120 billion of purchasing, this is going to reduce by $47 billion a month. So that is why the market has been spooked recently. And just to add to this, they're going to increase it from September this year. They're going to double the quantitative tightening to $95 billion a month. So that is quite dramatic and quite scary, and that's why we've seen the market drop from this high that we saw towards the end of last year, just over 4,800, to where we are now, 4,000 where we now 4,034 as we speak. So that drop there is about 16% from the high there to where we are now, 16% drop, which is fairly dramatic. And in case you're wondering, to get from there where we are today back to that sort of point where we were in February 2020, just before the pandemic, that would be another 15% drop. I'm looking at my notes here. So to get back to where we were could potentially drop another 15%. I'm not saying it necessarily will, because you know, the US economy at the moment is in a good shape, the lowest unemployment they've had in many years. But the concerns right now are that inflation is rising, and that could possibly lead to a recession going forward, at which point you could have a situation where there's high inflation and slowing growth, what we call stagflation, and potentially a recession. So that's why the market has been spooked, especially the last couple of weeks, coming off quite sharply. If you wanted to compare this to the South African stock market, in case you're interested, I'll just show you here. We'll add a symbol, South Africa top 14. The reason why I'm talking about the S&P 500 is that it closely resembles what happens on the South African stock markets. To give an idea how that works, we will just go here and we'll see just how closely that these two mimic each other. As the S&P 500 goes up, the South African stock market also does, and vice versa. So just wanted to give you an update of where we are and where we could potentially continue going. We are on this support line over here, and it looks like it might be breaking down below that. This support line, this uptrend, started in July 2020, and if we break that, we could potentially see further downside. So as my colleague Desmond Mayers that I interviewed last week said, there's massive liquidity that's been pumped into the market. Now they're looking at withdrawing that. So just be cautious here. And what can you do about it? So I think the question that everyone is thinking is what do you do about it? What should you do? So I think the answer to that question is it depends on your investment time horizon. If you think you'll need the money that you've invested into the stock market in the next year or two, well, then you might want to look at maybe selling some of your portfolio and going more into cash. However, if you have a longer term viewpoint, 5-7 years or more, you could sell a smaller portion of your portfolio in case you are concerned about the market pulling back even further. And if you've got a very long term view, that 10-15 years plus, then all of this shouldn't concern you too much, because eventually the markets will rebound, and timing is always very difficult. As they say, it's time in the market, not timing the market. However, realistically, timing is always a factor. Your portfolio will be very much dependent on the date at which you entered the market, and also the date at which you exit the market. So depending on your personal liquidity needs, you may need some of your investment in the next year, 2 or 3, and that influences this decision dramatically compared to someone who only needs the money in 10, 15 years. So there we go. If you have any questions, please feel free to comment down below. Please like and share the video with anyone you think that might find this interesting or helpful or useful. And you can always contact me on warrenes@afrifocus.co.za. That's Warren S at afrifocus.co.za. Welcome to, if you have any questions, pop me an email. Love to hear from you. Great stuff. Enjoy the rest of your day.